The war in Iran is raising the risk of a global economic shock, and energy markets are the tripwire. Disruptions to supplies of oil and gas are triggering double-digit price increases that risk reigniting inflation, potentially rattling a global economy that so far has taken multiple shocks in its stride. So what happens if supply disruptions stretch into weeks or even months? What are the economic and political consequences for US President Donald Trump and the global economy? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, supply shock. For people affected by the conflict right now in the Middle East, there are way more important questions than the price of oil and gas. They and their loved ones are facing life or death situations. But the focus of this show is economics. And in this realm, the big question is whether we're at the early stages of a global economic shock, one capable of triggering a recession. I'm going to tell you right now, we can't answer that question. It really depends on how long this conflict lasts. But we can look at the risk factors and who's the most vulnerable. And for that, I'm joined by Dan Burns in New York, our US economics editor, and Mark John in London, our European economics editor. Welcome to you both.
Thanks, Carmel.
Thanks, Carmel.
So let's lay out the stage for what we're talking about here. So the Middle East, not just Iran, accounts for around a third of global oil production and nearly 20% of global gas production. And in addition to that, we've got the Strait of Hormuz, which is a strait between the Persian Gulf and the Gulf of Oman, and that handles about 20% of the world's oil and around the same of its natural gas. So that's the biggest energy choke point in the world, meaning if it gets disrupted, we have a problem. And right now, tanker traffic has ground to a halt. So we're seeing an immediate reaction in energy prices. Mark, that's a big problem for energy importers, isn't it?
Indeed, like Europe, yeah. I mean, for Europe, the timing on this is terrible. Got over the COVID shock, but there it is with the Trump tariffs to deal with and the Ukraine war. So effectively, this kind of adds a potential energy shock on top of all this. And as you say, Europe, it's getting the vast majority of its oil from outside and a large chunk of its gas as well. So this is something which over time could be very significant.
Europe, but also Asia. I think something like 3/4 of Hormuz shipped oil goes to China, India, Japan and South Korea. So it's a big potential hit for those countries as well. And China has big strategic reserves. We don't know how big, but they do have them. India, as far as I understand it, is less well stocked. So the longer this goes on, the worse for them. Dan, in the US, is the United States sitting kind of pretty here? Because it's self-sufficient in oil, right, since the shale revolution, and it now actually sells natural gas into Europe.
Well, it certainly is in a better position than it was, and the last time there was a real significant potential for regime change in Iran back in 1979. Then we saw an oil price shock, exacerbate existing high inflation, and leading to a classic kind of wage price spiral that led to the highest inflation we'd seen really in the post-World War II era. But the U.S. is, as you know, it's much more self-sufficient now, but it's not entirely immune, right? A 10% increase in crude oil prices is going to translate into some increase in pump prices here in the United States. Some estimates are we could see it, bump up by, 25 cents a quarter a gallon in the next couple of weeks. And, that's from a price that had already been near 4-year lows in the beginning of January. And so that's going to be unwelcome.
So you mentioned the 1979, like the last big oil shock from this region, 1979, actually it was the Iranian Revolution of that year. And that was a massive oil shock. I think, oil prices nearly roughly doubled. We had double-digit US inflation. Since then, the world and the US are a lot less reliant on oil, right?
Oh, sure. They completely. I mean, US GDP in real terms since 1979 is roughly just a little bit more than tripled. But our oil consumption is essentially unchanged. right? So that share, that intensity of oil in the U.S. economy as a contributor, an input to U.S. output, is much diminished, something like on the order of 70% from what it was in 1979. So that really limits, the degree to which this can create the same magnitude of disruption through the same channel that it did in 1979.
And the US and the global economy is also, I think, helped by the fact that we've actually seen, big jumps in supply of oil, right, over the last few years. In fact, in previous pods, we've talked about like potentially like oversupply. So that helps the economic situation. But nonetheless, if this drags on, if we get into kind of weeks long, months long scenario, if we did see oil hitting $100 a barrel, how dangerous would that be for US and global growth, Dan?
It would be a drag, and certainly it would be an unwelcome development for inflation, which is something that's already running above the Federal Reserve's target by about a percentage point. Gasoline over the last couple of months had been a contributor toward weighing on inflation rather than adding to it. So reversing that dynamic in a moment when some other things like services inflation, non-housing services inflation has been a bit worrying for some policymakers. So there are already some underlying concerns about costs rising, and adding energy on top of that, which has not been a big contributor to that so far, could be problematic.
What about for Europe, Mark?
Yeah, so looking first of all on the relatively bright side, at least this time around, Europe doesn't have to de-risk itself completely from one single energy provider the way it did with Russia a few years ago. So that's one thing. Secondly, we're coming out of a winter, not going into one. So that's also kind of relatively advantageous. And the other thing is that, Eurozone inflation at the moment is actually below target, 1.7%, right? So, from that point of view, there is a little bit of a buffer. All of that being said, if this goes on, so the ECB reckons, for example, that 14% increase in the price of oil sustainably, that's worth about another 0.5 percentage point of inflation. And it takes off about 0.1% of GDP growth. Doesn't seem a lot, right. But if you haven't got much growth in the first place, then I guess every little bit counts, right? And this is the dilemma, I suppose, for the ECB, is that normally, as with all inflationary things, you'd be looking to potentially increase interest rates to kind of offset that somewhat. But it's not going to be very keen to do that with the economy in such a fragile situation, facing the Trump tariffs, facing everything else as things stand. So that does set up something of a dilemma for the ECB.
I mean, in terms of the inflation picture, back in 1979, what happened was stagflation, which of course is a nightmare scenario for economies, right? You've got, stagnating growth, rising inflation, rising unemployment, and kind of the cure for one affects the other, right? So if you ramp up interest rates to tackle the inflation, that's going to hurt job growth. We're in a very different situation now in the US and in Europe, right? It's as you mentioned there, Dan, inflation is it's above the 2%, the Fed's 2% target, but it's low by historical standards. So stagflation isn't something that we should be worried about right now, right? Is that fair to say?
It doesn't appear that that's a material risk. Some of the things Mark, John, we're talking about are kind of the inverse here. The fact that we're coming out of the winter in the U.S. actually means a seasonal rise in gasoline prices anyway. So this is likely to add to that, but not to the point where it becomes stagflationary is a big risk. The U.S. economy is what was looking at another year of outshining the rest of the world, certainly the rest of the developed world. By IMF estimates, U.S. growth was going to be about 2.4% this year. Whether this in a prolonged way shaves a point or two off that might be the case. But certainly, that was already double roughly what we were expected to see out of the EU. There were a lot of fiscal tailwinds coming into this year for the U.S. economy.
You mean like tax cuts, spending increases?
The tax changes from last year were going to, mean, households were likely to see bigger tax refunds in the next couple of months. Their paychecks are, in many instances, are likely to be higher on an ongoing basis because withholding taxes were coming down. The changes to depreciation on investments by businesses, it's hard to see how this immediately upends all of those themes. But the one thing, and Mark's alluded to this, it's that has been hanging over this. It adds another element of uncertainty, which makes businesses and households hesitant. They were already some hesitant around other Trump policies. We had the Supreme Court decision around tariffs, which has changed that dynamic pretty abruptly in the space of 3 to 4 weeks. But it isn't 1979. And the growth picture in the U.S. is generally stronger than it is, frankly, in Europe right now.
But does it take interest rate cuts off the table, right? Because people have been expecting them at some point this year from the Fed.
Off the table entirely, I think it's a little premature to say that. There's been some repricing in the early hours after the attack of expectations for when the next Fed's rate cut may occur. It's now less likely to occur in June than it was at the end of last week. Not extremely so. And there is still pricing there more or less for 2 rate cuts this year. But there's some confidence wavering about whether it's 1 or it's 2. But it's not like a wholesale sea change in expectations for what the Fed's able to deliver this year. But it will add to that wait and see mentality that we have seen developing inside the Federal Open Market Committee, as reflected in the minutes from the January meeting and comments from a lot of policymakers coming out of that.
The conflict in Iran is rippling across the Middle East and the wider world fast. To stay across all the developments, Reuters has launched a newsletter, Reuters Iran Briefing, with the latest headlines and in-depth analysis 6 days a week. We'll put a sign-up link to that newsletter in the description of today's show. Up next, we look at why Iran is such a big political gamble for President Trump. You think, Mark, investors are blasé about geopolitical risk because we've had so much of it, even since the start of this year, and it's only early March?
Yeah, I mean, I was actually just reading before coming on here. Actually, there were a couple of notes saying exactly that. But yes, as Dan's saying, the impact so far on markets has been relatively small. But some people are starting to think, actually, are we underpricing the risk here? Are we assuming that this can be contained somewhat easily? And what happens when that proves not necessarily to be the case?
Dan, one thing that's coming out of all of this is we've seen a boost in the value of the dollar. It's sort of resumed its safe haven status. There is a risk here, isn't there, for a protracted surge in the dollar, which the Trump administration presumably don't want, because they seem to want a sort of a slightly weaker dollar to improve the trade deficit, to boost exports.
They do. It's a little bit of a soft shoe act on their part, but there's been no alarm inside the administration about what we'd seen as a pretty demonstrable downdraft in the dollar through the latter part of 2025 into the beginning of this year. Again, it's early days. We don't know if this is the start of a real reversal of that, but certainly a stronger dollar hurts the competitiveness of U.S. exports. And they're fighting hard on the policy front through tariffs and other means to revive U.S. manufacturing and to revive the U.S. goods export scene, to cut into that massive goods trade deficit that the United States still runs, despite the efforts of the Trump administration so far. I'm not yet convinced from a trend perspective that we've seen the downtrend in the dollar broken yet by this.
Do we know how much economics, if at all, came into play to the decision around attacking Iran? Like the kind of thinking through the economic consequences of it.
We don't know directly from our reporting. Our reporting has reflected from the White House that there has been a camp of advisors who would prefer Trump to have a greater focus domestically and not on conflicts. This is not the first since just the start of this year. We've had Venezuela. We've got ongoing pressure being put on Cuba. Polls show that Americans would prefer Trump to be focused domestically, particularly on the economy.
That's right. We had a recent Reuters Ipsos poll, I think, showing just 1 in 4 Americans support these attacks on Iran.
And that support diminishes the longer it goes on, and the greater the effect it produces on things like gasoline prices. That support erodes pretty quickly in those circumstances.
It also has big consequences for American allies in the region, right, Mark? We've seen, the Gulf powers, Qatar, the UAE, Kuwait, Saudi Arabia, all facing Iranian retaliatory strikes. And, these are countries that, since the last Iranian revolution back in 1979, they have established themselves as financial hubs for the rich and the mobile. They are much bigger players now in the global economy.
Yeah, absolutely. So, already they've seen airport closures, there have been halts to port operations and so on. So our colleagues in the region who are looking at this, as you can imagine, very closely, are calling this already the most widespread disruption to that business model really since the pandemic. As you say, a lot of time and money has been spent up building this reputation as one of the world's most reliable business hubs. So clearly, if this were to continue, there would be questions as to whether people were still willing to put their money there, willing to settle there, and so on. And then, the more specific questions around, the industries of, luxury tourism and, the airport hub and so on. If this disruption continues, then clearly that is already directly threatened. Nowhere more so, obviously, than the centre of Dubai, which in many ways kind of epitomizes that trend that you mentioned. There's a couple of countries, obviously the producers, Saudi Arabia and Qatar, who stand to benefit, if only thanks to elevated oil prices, which is going to give them a nice fiscal windfall, presumably.
But there's then the other side of it where, their ports are closed. They can't, in many cases, get imports in.
Yeah.
And a lot of these economies are very reliant on imports for sort of everyday goods and services.
Very import reliant. I was just listening to one of my colleagues earlier say that there are already reports of hoarding in the region. So presumably, households are concerned about that too.
For Europe, it's another example, isn't it, of its vulnerability, its energy dependency being exposed, because the gas price in particular has surged. And okay, for Europe, at least we're going into the summer now, so it's not a crunch time, but it really exposes Europe's energy vulnerability.
It does, doesn't it? Yeah. A few years ago, obviously it was Russian gas, and an enormous effort was made to wean themselves off Russian energy. That came largely thanks to things like buying in US LNG cargoes. And, if this carries on the way that it is with, Qatar, for example, earlier announcing suspension of its LNG supplies for the time being, then Europe is going to be competing with other Asian customers for LNG cargoes, and that will push the prices up.
Dan, for Trump, the timing of this, we've got sort of midterm season kind of kicked off this week with I think primaries in Texas. The timing of this, it's quite risky, politically risky for him, isn't it? Ahead of the midterms.
It is. We're 8 months out from the midterm elections, which typically an incumbent president's party does not fare well. Baseline expectations are for Republicans to lose the House of Representatives. We're seeing some indications that there's the potential for a Senate flip as well. There's a real political risk, as we were talking about earlier. The polling here is not favorable on this action among Americans, and Trump's stewardship of the economy, which is always the most important election issue for U.S. voters, was already low.
Right. The affordability. This definitely isn't going to help affordability.
This is, so far, it doesn't look like it's going to be a boon for affordability. Whether it's a big knock on it is a different question, but it certainly doesn't look like it's something that gets him points in the affordability bucket going into a November midterm.
Because American drivers, American voters have got used to cheap gas, right?
They do. And where inflation is concerned, gasoline has a very high psychological importance. Anybody who has spent any time in the United States knows that it's a price that you see everywhere. So it is burned into their consciousness probably far more than the price of bread or eggs, which Trump has been touting as falling. And they see that change in real time. And it has a big psychological effect on people's perception of where inflation is heading.
Dan and Mark, thank you so much for your time.
Happy to help out, Carmel, as always.
Pleasure.
A big thank you to Dan and Mark for taking the time to talk to me. Remember, to stay on top of everything that's happening in the Middle East and beyond, check out Reuters.com and the Reuters app. And for a daily catch-up on how events are playing out on markets, check out Reuters Morning Bid wherever you get your podcasts. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, drop us a line in the comments section of your favourite podcast platform or reach out to me on LinkedIn. This episode was produced by Ethan Plotkin. Sound design, music composition and engineering was by Josh Summer. Graphics were courtesy of Ben Welch and Iris Lee. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out Reuters World News on the Reuters app or wherever you listen to your podcasts.